Hello and welcome to Inderes TV. Neste reported its Q2 result on Thursday, and now I'm in the studio with analyst Petri Gostowski to discuss the result. Hi Petri.
Hi
and
there.
welcome.
Thanks.
So let's start with Neste's tops and flops during Q2.
Yeah, well, if you look at the figures, not very many tops there. I mean, overall, a tough quarter in renewable products, and then obviously oil products was impacted by the major turnaround in the operations. I guess you could say a top was that the turnaround was successful. I mean, these are always huge projects, and many things can happen, but they did well.
Yeah. So overall quite negative, but a little bit of something good in there.
Yeah.
So renewable products were softer than expected, and the company adjusted its guidance based on this. What is behind this, considering that this should be a driver for the future? Is this a cause for concern?
Well, the biggest driver obviously has been that the supply has grown a lot, especially in North America. So the market is growing, so demand is growing, but I think at least now temporarily we have a kind of like oversupply situation. So that's obviously driven margins down. But given that the growth path should be solid for the coming years, I'd expect that to be more balanced, the supply demand in the future.
Okay. Oil products suffered from the Porvoo major turnaround. What is the outlook for oil products going forward then?
Well, obviously we've come from a very good market situation from last year, and I think now the margins in the oil products are more like a kind of normal level. They're very healthy, maybe even a bit higher than historically. So all in all, the outlook looks pretty good. The economy is a bit suffering, so we would expect to see a bit lower demand than maybe the past few years, but yeah, nothing out of the ordinary.
Okay. Both operating net cash flow and free cash flow were negative in H1. How do you expect these to develop during H2?
Like you said, H1 was difficult in terms of cash flow. You know, you have a weak market. That's why you have a weak earnings and cash flow, and then you're investing heavily currently. So yeah. And then also you can see that the ramping up of SAF sales volumes, especially in Singapore, has driven inventories up, and that ties working capital. Obviously now they should be able to sell more SAF volumes in H2, so we would expect them to clearly have lower inventory levels, and therefore working capital would be supportive, and obviously earnings expectations for H2 are quite a bit higher, so I'd expect a very different type of cash flow in H2. Okay.
And the company expects H2 to be clearly stronger than H1. Is this also your view, or what's your view on H2 in general?
Yeah, I mean, most of this comes down to the SAF volumes. If you think about renewable products margins, they are clearly a higher margin product, so we would expect to see this supporting renewable product margins. And we've seen some early indications from the market data that the market situation is a bit better. Maybe we are past the through in Q2. So yeah, I think the overall picture looks supportive for H2, but we've seen rapid turns in the market. So yeah, we're still. I'm eager, not eager to make any definitive calls, but yeah, it looks better for H2 currently. Yeah.
Good. And what about the longer run? What are your expectations, for instance, for next year and going forward?
Yeah, obviously going forward, like I said, I mean the demand growth should eat out the oversupply we have currently. Obviously, there's a lot of going around globally in what drives demand and whether there's new investments coming. We've seen some investments pulled back now, so that should make it even quicker for the demand growth to eat out the excess supply. So yeah, I mean the growth outlook looks healthy, and I would expect this to drive the overall renewable products margins somewhat higher. Our long-term estimates are clearly higher what we've seen in Q2, but I mean the Q2 levels are not sustainable because many players are losing money, and this will eventually bring up a lot of trouble if this would continue. So So definitely, I believe that margin outlook looks better in the long run, and therefore the higher margins will be obviously a profit driver for Neste, but also they are ramping up capacity. So you will have a lot of more capacity from the Singapore line that's been ramping up this year. And also the U.S. Martinez refinery has been operating this year only at a 50% run rate. So there's a lot of room for volume growth. And then if we look even further, there's the Rotterdam expansion going on now, and this will bring volume growth then in 26 and beyond that also when they ramp it up.
So the longer term looks brighter.
Yeah,
obviously.
definitely. Yeah.
And finally, then, what about the valuation and recommendation? Where do we stand here?
Yeah, I mean the valuation has come down a lot due to this weakness in the renewable products sales margin, and given that our expectations for renewable products earnings are clearly higher, if you look out maybe 2 years, the valuation is low for the midterm. So definitely we see it as tempting, and our recommendations accumulate.
Okay, thank you very much, Petri.
Thanks.
And you can find the latest report at inderes.se.